A personal loan is typically a small dollar debt that can be used to pay bills or make purchases. For example, let's say that your friend Justin makes $22,500 per year. Although he generally makes enough to cover his living expenses from his paychecks that he receives every 2 weeks, this month he needs an extra $350 to pay all of his bills. What advice would you give Justin if you knew that he has a steady job but just not enough cash coming in this month? Well, many people would suggest that Justin use his credit card to pay his bills or take a cash advance on his credit card from an ATM. Although it's true that he will pay a fee for the cash advance and pay interest on the loan, accessing cash this way is far better than taking a payday or a car title loan. After all, the typical payday loan in the United States carries that APR of over 300%. But if Justin doesn't have a credit card, he'll need to pursue other borrowing options. So those options might include cash advances from a credit card, asking a friend or family member for a loan, requesting an advance on his paycheck, or contacting the companies he owes money to, explaining his situation and asking for a modification to his billing plans. People like Justin often feel trapped into using either a payday or a title loan borrowing option because they simply don't know where to turn for a short-term, small dollar loan. There are several types of personal loans. They include secured loans, unsecured loans, installment loans, personal lines of credit, deposit advance, and peer-to-peer lending. Secured loans are backed by collateral, so that would be property like a car or a valuable item that can be taken away by the lending institution if the borrower fails to repay the loan. Unsecured loans are not backed by collateral, and they're sometimes called signature loans because there is no collateral involved in the lending process. As a result, an unsecured loan is considered to be riskier than a secured loan and therefore carries a higher interest. With an installment loan, the borrower receives the full amount of the loan up front in a single lump sum. The interest rate is usually fixed and the payback period is usually fixed, in contrast to credit cards. Repayment periods generally range from 1 to 5 years. When borrowing money for the purchase of an asset, such as furniture or an automobile, a best practice is to make sure that the loan repayment period is shorter than the expected useful life of the asset. A personal line of credit looks similar to credit cards, allowing the borrower to maintain a revolving balance from month to month. It's usually unsecured, and the bank informs the borrower how much may be borrowed in total. The borrower is given a debit card or a checkbook to access the line of credit. The borrower can then access the line of credit whenever they need to, and interest is only paid on what they borrow. A deposit advance is a short-term loan that is automatically repaid when the next qualifying electronic deposit is made, like the next paycheck. So the borrower must have a checking account and a history of regular electronic deposits of paychecks, federal benefits, or other deposits. So when a loan is needed, the borrower pays the bank approximately $10 for every $100 borrowed. The borrower then has 35 days to pay back the loan. So these loans compete directly with payday loan services, but at a much lower cost. Peer-to-peer lending allows a borrower and lender to come together via the internet through services such as Lending Club, Peerform, and Prosper. It allows people 18 years of age or older to enter their personal information into a database. Each service provider creates a lending score that is driven by a borrower's credit report. Those who have at least a 650 credit score can then ask lenders, known as investors, for a loan. Loans can range from $1,000 to $40,000, and interest rates vary but generally do not exceed 32% APR. The marketplace has really stepped in to help people make loans to each other rather than through a company. So, although these lending sites do charge a loan origination fee, peer-to-peer lending offers a way for many consumers to obtain a lower cost loan.